The valuation rules of customs. So how is customs duty valued? So how do you arrive, or at what rate, on what value do you charge the customs duty, is what we are going to see today in today's lecture. So basically the valuation of customs duty is done on two important bases. The first one is transaction value. We call it as TV. And the other one is done based on the tariff value according to the Customs Tariff Act. The value of imported and exported goods shall be the transaction value of that particular goods. How do you arrive at the transaction value? The most important thing is that your transaction value is the value of the price actually paid or payable for the goods which have been imported when sold or export to from India. So it's the price that you pay to import goods, or when you're planning to export certain goods, the price you collect or the price you pay will be the value which will be. And for delivery at the time and place of importation or exportation, where the buyer and seller of the goods are not related, there is certain conditions. Do the valuation based on transaction value. There is a normal sale, there is a normal import or a normal export, or there is an export or import which is done from a related buyer, from a related seller or a buyer. So for that, the valuation are a little different because subject to certain conditions. Price is the sole consideration for the sale, subject to other conditions specified in the rule. The customs valuation determination of value of imported goods rules 2007 is relevant in this particular regard. Under section 14 of the Customs Act, value shall be the transaction value, that is to say the price actually paid or payable when the goods are sold for export to India. For delivery at the time and place of importation, or as the case may be, for export from India for delivery at the time and place of exportation. So any goods which are intended to be delivered into India, the transaction value will be the price that is being paid to the goods that have been imported. Section 14, buyer and seller are not related. So the first important thing that you need to know is that they should not be a related person sale. Then price is the sole consideration for the sale, subject to other conditions as may be specified in the rule. Transaction value shall include, in addition, apart from the basic price, what is being paid from the goods. Apart from that, transaction value will also include amounts for costs and services for such imports, licensing fees or license fees, the cost of transportation to the place of importation, insurance relating to that, loading, unloading, and handling charges, to the extent and the manner specified in the rules may provide for circumstances determining the relationship, if it is a related buyer or related seller, or whether it is only sole consideration is price or not. So depending on the circumstances, the relationship will be determined. The method of valuation, when there is no sale or when parties are related or price is not the sole consideration or any other case, manner of acceptance or rejection of value, where the officer has a reason to doubt the accuracy of the value. Where price is not the only sole consideration, in such cases, the value will be arrived at determining the circumstances and the relationship with the importer and exporter. Import. The valuation rules are based on GATT, generally accepted trade and tariff, now governed by the WTO rules, World Trade Organization rules. Originally was framed in 1988. A major change to Rule 4 in 2001. Customs valuation or determination of value of imported goods rules 2007, introduced from 10/10/2007. Changes in definitions. Transaction value means the value referred to in section 14. Under the old rules, transaction value is the value determined under rule 4. Valuation rules. How do I determine the value of the imported goods with the help of the valuation rule? So the methods have to be applied in a sequential order, a step-by-step process. When the first method is not applicable, the second method has to be applied, and so on, so forth. So that there are many valuation rules which are given: Rule 3, Rule 4, Rule 5, Rule 6, Rule 7, Rule 8, Rule 9, Rule 10. Like that, various rules are given. Depending upon the situation, sequentially we need to organize and introduce the rules or method of valuation. If transaction value is rejected by the department, or department has to go sequentially and cannot straight away adopt the residual method. The first rule, Rule 3, value shall be determined, or value shall be transaction value subject to the adjustments of the following. Value of the imported goods shall be accepted provided that there are no restrictions as to disposition or use, excluding territorial and legal and minor. So there should not be any restrictions for importing of such goods. Price is not subject to some condition or consideration for which value cannot be determined. No part of the subsequent sale proceeds accrue to the seller. Buyer and seller are not related. So rule 3 very clear. These are the conditions. If the valuation has to be done under rule 3, the buyer and seller are not supposed to be related. Rule 3, where buyer and seller are related, price can still be accepted if it is demonstrated that the relationship has not influenced the price. So if you have to do the transaction, or if you have to arrive at the transaction value under rule 3, condition is that it should not be a sale to a related person. So price should be the sole consideration for deciding the transaction value. But in case where there is a related person sale, you can still do the valuation under rule 3, provided that you prove that the relationship between the seller and the buyer has not affected the price of the imported goods. It is the same price whether you are a relative or not. It is the same price which is being charged. Rule 4, identical goods. So identical goods, the transaction value shall not include provisionally assessed rule or values, same commercial level, same quantity, adjustments for differences, adjustments for differences in transportation cost. When multiple value are available, lowest value of the identical goods are to be adopted. Rule 5. So rule 3, transaction value. Rule 4, identical goods. Rule 5, similar kind of goods. They are not identical, but they are similar. The lowest price will be adopted. Rule 6, where value cannot be determined under rule 3 or rule 4 or rule 5, wherein we cannot determine any valuation under 3, 4 or 5, then value has to be determined under rule 7 at the request of the importer and with the approval of the proper officer. Rule 8 can also be applied first, and then rule 7 can be applied. So that is the rule number 6 on the other valuation. Rule 6 says that you have to apply rule 7, or with proper approval, rule 8. Let us look at what is rule 7. Deductive value. What do we mean by deductive value? Again, the sale price in India will be taken, whatever is the Indian currency, Indian rupees. Deductions for commissions, transport, insurance and associated cost in India, duties and taxes on import or sale. Where there is manufacture and sale deduction for value addition shall be given. Sale must happen within 90 days after import for this rule. Whenever some machinery or some product is being imported and there is some value addition which is given to the product, in such cases, deductive value under rule 8, computed value. Value shall consist of the sum of A, cost or value of materials and fabrication or other processes employed in producing the imported goods, profit and general expenses in respect of goods of the same class, and transportation and loading and insurance. So value shall be consisting of the sum where value of materials and fabrication and other processes employed in producing the imported goods. So this is a computed value wherein even after import, there are certain fabrication and materials has to be used in order to make the product complete. Rule 9, residual method, where value cannot be determined under the preceding rules. It shall be determined using reasonable means consistently the principles and general provisions of these rules and on the basis of data available. So value shall not exceed the price at which such or like goods are ordinarily sold or offered for sale for delivery at the time and place of importation, when the seller and buyer has no interest in the business of each other and price is the sole consideration. This is under residual method. Rule 9. Rule 9, no value shall be on the basis of selling price of goods produced in India, highest of two alternative values, domestic price in the country of export, export price to another country, cost of production, minimum customs values, arbitrary of or fictitious value. Rule 10, cost and services. The following shall be added to the price paid or payable, provided it is not already included: commissions and brokerage other than buying commission, cost of packing, cost of containers, goods and services supplied free of cost by the buyer or at a concessional rate. So what is rule 10 valuation? See, each rule gives valuation for different kind of imports with regarding to customs. So rule 3 talks about transaction value. These are certain valuation of certain products which also have some cost and also services. Royalty and license fee related to imported goods that the buyer is required to pay directly or indirectly as a condition of sale. Value of any part of proceeds of any subsequent resale or disposal. Other payments made by the buyer to the seller or third party to satisfy obligation of the seller. So now this is rule 10, wherein a royalty and a license fees is paid. When do you pay a royalty and a license fees? Whenever you are trying to import some technical know-how. Rule 10, royalty and license fees. An explanation provides that where royalty or license fee or any other payment for a process, whether patented or otherwise, is includable, such a charges shall be added to the price paid or payable, notwithstanding the fact that such goods may be subject to the said process after importation of such goods. There is a board circular which has been issued in 2007, refers to the post-importation activity like running of machinery when the process is put to Toyota Kirloskar motor. Capital goods and parts were imported from Toyota, and the question was whether royalty and know-how fees should be included or not in the value. The Supreme Court held that payments for post-import activities cannot be included. Amounts payable for as a condition of import of goods for motors governing the manufacturing activities are distinct, and such payments are not related to the import of capital goods. Amounts cannot be. Rule 10, clause 2. Cost of transportation, loading and unloading and handling charges to be paid. Insurance to be added. Explanation provides that cost of transportation of imported goods includes ship, demurrage charges and chartered vessels, lighterage or barge charges. So the new explanation will increase the value since all these charges will now have to be added. The other rules, valuation rules 11 and 12. Valuation rule 11 deals with declaration. Rule 12.1 deals with rejection of a declared value and explanation to rule 12. Rule does not provide for a method of valuation under rule 12 where declared value is rejected. Value shall be determined by proceeding in accordance with rule 4 to rule 9. Officer has the powers to raise doubts on truth of accuracy of declared value based on certain reasons, which may include significantly higher value at which identical or similar goods imported in comparable quantity in comparable commercial transaction were assessed. Abnormal discount or abnormal reduction from ordinary competitive prices, special discounts limited to exclusive agents, misdeclaration of origin, quality, quantity, etc. parameters, non-declaration of parameters such as brand, grade, specifications that have relevance to value, fraudulent or manipulated. Payment has to be made in the concerned country currency. Say, for example, you are importing some from some products from US. You will have to pay in dollars. And this exchange rate, since it is fluctuating, it is fixed by the Central Board of Excise and Customs on the last week of the month. And for the next following month, they will find out the value or the price of the commodities imported only based on the price which was being fixed. Even though on a daily basis there is a change of exchange rate, the rate of exchange determined by the CBEC, Central Board of Excise and Customs, are ascertained in a manner as the CBEC may direct. Note: exchange rates are determined and announced by CBEC during the last week of the previous week. This exchange rate is applicable for all bill of entry filed in the next month. So in the last week, they fix up a price. Let us look at an example to understand it better. How the CEBC decides a single rate for one full month. Example: ABC manufacturers have imported machinery from US worth $10. Determine the exchange rate for the purpose of computation of customs duty from the following additional information. Particulars: date, exchange rate as per the notification by CBEC, exchange rate as notified by the RBI. So the date of bill of entry is on 24/10/2013, 68 rupees per US dollar as per the exchange rate of RBI, 69 rupees, and the date of entry of inward is 70 rupees per dollar and 71 rupees according to the RBI. So what will be the exchange rate? The exchange rate here will be determined by the rate which is fixed by the CBEC, which is at 68 rupees per US dollar for the next entire month. So solution here: exchange rate in the given case will be the rate of exchange notified by the CBEC on the date of presentation of bill of entry, that is 24/10/2013. Hence the rate of exchange for all purposes of computation of customs duty will be rupees 68 per US. Relevant date for exchange rate: the price shall be calculated based on the exchange rate on the relevant date. For imports, relevant date is the date of presenting bill of entry under section 46. And for exports, relevant date is the date of presenting shipping bill or the bill of export under. So these are the, now we saw transaction value. Now the next method is based on tariff value. If the CBEC is satisfied that it is necessary or expedient to do so, it may fix the tariff values for any class of imported goods or exported goods or export goods, having regard to the trend of value of such goods or like goods. Where such tariff values are fixed, the duty shall be chargeable with reference to such tariff value. According to the tariff rules, whatever is being fixed, they are going to do that. Relevant date for rate and value. For imported goods under section 15, these are the relevant dates and the relevant tariffs being fixed on that particular goods. So section 15 prescribes the relevant date for determining the rate of duty and tariff valuation, if any applicable to any imported goods in the following manner. In case of goods entered from home for home consumption, the rate of duty will be on which a bill of entry in respect of such goods is presented, subject to certain conditions. Goods cleared for home consumption from a warehouse on which a bill of entry for home consumption in respect to such goods is presented. And any other goods on the eve of payment of for exported goods under section 16, this is the date. In case of goods entered for export on which the proper officer makes an order permitting clearance and loading of the goods for exportation, and any other goods or payment of duty. In respect of baggage and goods imported or exported by post, the provision of section 15 and 16 will not be applicable. Okay, if it is done through post, this is not applicable. This is applicable only by way of sea. Now, what is the customs procedure? Landing of goods. The moment they have landed onto the concerned port or customs waters, delivery of the import manifest or report, grant of entry inward to the master or of vessel, or permission to unload the goods, unloading of the goods, unloaded goods to be in the custody of the custodian until their clearance, and filling of entry for import, that is bill of entry. You have to do all these things in order to get your import procedure and also clear your customs. The timing of entry of bill of entry, assessment duty, that is assessment of duty, payment of duty, clearance of imported goods from customs station, clearance for home consumption and warehousing, transit in goods and transshipment. There you go. This is a brief procedure for imports of goods has been depicted in the diagram. You can see that goods arrived at the Indian customs station. There is an import manifest or report delivered by person in charge to proper officer. Entry inwards, granted by proper officer to person in charge. Unloading of goods at the customs port under the supervision of proper officer at the approved places on working days at working hours. Then goods under the custody or custodian, and then electronic filing of bill of entry filed by the importer with proper officer, and then the goods can be released for either for home consumption or for transshipment or for warehousing.